there. If gold is outperforming CPI, then it's front running. The market aggregate of market participants are pricing in higher gold price because they think the CPI is going to keep going up, right? So until this rising trend line here is support line is broken, where it's a new bull run for gold versus money supply. So that's more compounding evidence, versus inflation you're breaking out. So people saying, oh, how come silver's not doing a new high? Well, because gold price in inflation has not done, it's not in a crazy bull run. It's not up here, right? Because so silver tracks that pretty much. But look what happened. Gold broke out. Let me reset the chart here. Look what's happened. As gold's breaking out, look what silver's doing. It's tracking that.
Yep.
So that was very omen-like. When gold broke out here versus inflation, and it did a beautiful back test and broke out, finally silver.
Hey guys, welcome to Capital Cosm. Patrick Kareem is back on the show. Thanks for coming back on, Patrick.
Hey, Danny. Always fun. Always fun.
So, Patrick, let's just dive right in. What is your general overview of the markets at the moment?
Well, goodness, a lot is like, I don't know how long we've talked there, but yeah, a lot's moved. Silver broke out on the weekly time frame. The monthly, we're going to see at the end of the month. On the quarterly, it's hanging above a breakout line. If it closes, anyways, I could show you charts later for your members, but for your viewers, it could get a quarterly defined breakout. Gold's already been leading the way. Gold's broken out versus inflation. The markets, it's tricky, right? I could show you some breadth indicators for the Russell. It's not looking super good there. It's kind of sketchy. The SPX is fine, but more importantly, to really help people out figure this stuff out, there we could probably show the members how they could use chart trading and different time frames to spot when the turnarounds could start happening, right? Because some people let's say we get a monthly defined breakout, and then they have these crazy targets, but after that they forget that you could have pullbacks on the daily, you could have pullbacks on the weekly, but how much is too much of a correction or pullback on the daily, which cascades on the hard time frames and makes it you're more at risk, of opportunity cost, etc. So we could look into that. And but yeah, for the commodities there, it's been a full fire ahead there. Coal, oil, uranium went a little hiatus there a little while back, but they're still like consolidating. There's some uranium stocks that they never stopped going up. So it's yeah, it's moving along there. It's like it's a bull era in commodities that people keep doubting, but these big base breakouts, they don't come, once you spot them, you have to prepare yourself, because you only get, it takes 4 or 5 years to get a big base breakout. These big consolidation pattern breakouts, they take 1 year or 2 years to break out. They're breaking out also in a whole bunch of different stocks, especially like, let's say, the oil plays. It's just crazy stuff. And yeah, that's pretty much what's happening there. So it's all about proving or showcasing visually to your viewers there how I'm coming around to these conclusions, right? Because some people, they just look at the fundamentals of a company, and they look all that, and that's how they confirm their bias of the trade. But like, I don't do that, or I refuse to do it. I could look at fundamentals of a company, but for me, it's just like, I know I'm wasting my time, because at the end of the day, you're going to be looking at it, this other guy's going to be looking at it, and all these different people are going to be looking at it, piling in their money, and I'll just see the aggregate of all these people making their decisions. And yeah, just to finish that long rant, you got to remember, guys, the sectors, let's say the SPX, let's say that I have the XLE there, the XOP, one of these sectors, but then I look at most of the charts in that sector, they're going to look like the XLE. Some are going to be leaders, some laggards. They all have different like companies. Some are smaller cap, bigger cap, different management. They're drilling in different places, like a whole bunch of variables. But goodness, guys, did you ever ask yourself, why are all these charts looking the same? Even the companies with bad management, the chart could look as good or even better than a chart with a company that has good management. And when you come to that evidence, you have to see that it's the capital flows, these passive ETFs, or wherever the money, like the money's piling in, right? it's flowing to somewhere. There's something triggering these big pension funds or hedge funds of putting money in that sector. You could spend a lot of time like trying to diagnose which is better company or two, but at the end of the day, they're pretty much all those charts are going to be carved out by the more important tidal waves of capital flows. And that was my rant. You're very patient to let me do all this rant, Danny. I'm impressed.
No, of course. I mean, it's all valuable information. Well, you mentioned the commodity market seeing a little bit of a rise there. You can also see it manifest in the CPI print. CPI print came in at 3.5% this week. What does this really portend? Is this bullish or bearish for the commodities market? On one hand, you do see signs of a secondary inflationary wave. On the other hand, it could trigger the Fed to hike rates even further, which is the running rumor at the time of this recording.
What's more important is, are the commodities outperforming inflation? Because the market's smarter than these like lagging indicators, like, you know, the CPI and all that. And people could say they're bamboozled. But if oil is outperforming CPI, and or I could have a great example there. If gold is outperforming CPI, then it's front running. The market aggregate of market participants are pricing in higher gold price because they think the CPI is going to keep going up, right? And the market's forward looking. And when the CPI peaks, that's when all the crowd's looking at the CPI. Oh, we're at 10% CPI. Gold has probably already had peaked months before that and already starting to roll down the moment the highest print of CPI happens. And if gold's starting to break down, it's telling you that it's starting to price in lower CPI. And then on the way down, as gold's going down, the CPI is going down, lagging it. And then after that, gold, what happened to gold? Gold broke out versus CPI. And then CPI it's telling you that CPI is going to start, you know, going up, but probably later, you know. So I would look more at the commodities themselves, at the price of oil, the price of gold, and all that. The CPI, it's fun, it's high, but for me, it's mostly like it's not tradable, actionable stuff. And if you're waiting for those prints to happen, a lot of the pricing in, the only thing you could get lucky with CPI is, let's say there's a new high CPI print. I could say you're getting lucky. As long as gold is outperforming CPI, then there's nothing to worry about. Even if CPI is at all-time highs, but gold keeps outpacing it. Look, I'll show you the best thing I think is just to show you guys a chart there.
Yeah. So essentially, the CPI is a lagging indicator, and gold's more of a leading indicator, you could say.
Yes, let's say I put the gold chart here. I might show you this chart that I was working on with Kevin there right before we talked. So here's the remove indicators, remove drawings. So here's the gold price, and here I'll do gold divided by CPIA. I'll do it this other way. I'll do a plus. I'll add gold divided by CPI, and we'll put on a new pane. Look at the bull runs in gold. The bull runs in gold, I'll put on the log scale here. The bull runs in gold happen when it's breaking out versus CPI. So you cannot have a bull run in gold if it's going up nominally, but it's not outperforming CPI. The price of gold might still be going up, but I'll tell you why this is important for the rest of for silver and the miners. You need gold to break out versus CPI. So here you have gold breaking out versus CPI. Back in June of 2019, and it broke out at the same time versus its price chart. That's great. No matter what the pricing in of CPI was, gold was breaking out. And maybe this will make more sense if I put the actual CPI chart in a pane below. Oh no, I'll do the year over year. So it'll be inflation rate year over year, price scale. Where am I? Clean that. Put that in new pane below. Okay, here. So I have 3 panes, guys. I have the gold price. Gold price is in a bull era when its price is going up, but when also it's outperforming inflation rate, and it did that. It broke out again. Like, it depends how you draw this. It broke down, back tested, and it's moving up versus inflation. Look here, this at the bottom pane, guys, is inflation rate. And I'll show you something crazy. I put this chart back on Twitter a while back. Gold will break out before inflation breaks out. So here you have gold breaking out, but inflation is going down. People say, what? How could gold break out? Inflation is going down. It went down, Then inflation started going up, and then it dropped here. That was March. COVID. Sorry, I got your channel banned. Is
Uh-oh.
that still a thing on the
What,
algorithms?
COVID? No,
If
that
you
was
see,
complete. No, I'm just kidding.
so, but if it wasn't for that, look, see, gold broke out as inflation was bottoming, not when it was peaking, right? It broke out, and look here where gold peaked. Gold peaked before CPI went all the way top. Here, wait, that one here. Yeah. Gold peaked when CPI was starting to move up, and before it peaked, and when CPI peaked, gold started going down, and here gold's going up before CPI. So you could expect something like this here happening again. Once again, that's what gold is telling you. The fact that it's broken out on its own price chart, but not only that, it's broken out versus CPI. It's front running the next purchasing. Can I go in the 80s here? 90s? See, gold's breaking out, and then CPI is starting to go up after the fact, right? So
Yeah.
it's not a high
So the
CPI print that makes here. You see, when the CPI is high, gold's actually bottoming, right? You need CPI to go up. It could be high, but you want CPI to keep going higher. But CPI will be going higher if gold keeps outperforming it and starts going up until gold breaks down. When gold breaks down here, 2013.
Yeah, so you can expect the year-over-year CPI number to move
Yeah.
as soon as gold price in the CPI begins to move, essentially.
Yes. Yeah. So you
Got
can't,
it.
like, the CPI, you can't really, I don't know. It's not really
Well,
something to trade there.
what about the M2 money supply? Is that something you look at versus gold?
Yeah, you could do it. You could do it also. I
And
think
does
it's
that does
less than,
that does that tell a similar story?
yes. So you'll see gold also outperforming money supply because inflation rate is practically the momentum or the rate of change of money supply. I could have put I could show that. I'll just show you guys real fast. This M2SL. If I do a rate of change on the money supply, add indicator on money supply, and I'll do a ROC, rate of change. Here.
And that
So
gives you
here's
a year-over-year view?
yeah.
Okay.
Yeah, here. So here's a 9 month. I'll do maybe 12 months. Look, it's not the inflation rate per se, but it's
Yeah.
the change in there's a lagging there. The money supply here, rate of change goes up, then inflation goes up after, etc. Then look, see the rate of change of the money supply year over year drops. What happens to the inflation rate? It drops. So it's not a perfect correlation, but the
Well,
more they're
well,
printing, it's not how much they're printing, they're always printing, right? Because you see here, it just bottom left to top right. They keep printing. It's how fast and how slow, it's the markets, guys, they don't, when I hear, oh, there's $20 trillion debt, and then, oh, it's a big number, and right away people assume it has to start going down. It doesn't work that way. The market, it's not thinking linearly, it's thinking rates of change. How fast and how slow are they pressing and letting go of the accelerator? And that's what creating these fluctuations in the rate of change in the inflation rate, right? The year over year. But overall, nominally, most of the stuff will always be higher and higher because it just compounds, right? This rate of change of inflation, unless it goes negative and we have deflation, you're compounding nominal, like, no, the price of everything's going up, right? So it's just, while the inflation rate could go down, as long as it's above zero, there's nothing, the price, these lines here on these long-term charts there, it's bottom left to top right, right? The stock market, bottom left to top right over 200 years. Gold, bottom left to top right, right? Silver, it used to be pennies, a quarter for an ounce of silver. Now, wherever it is, $30. It's always bottom left to top right because that's the compounded effect of these year over year of positive, even 1% or 0.1% of inflation rate year over year still will raise everything, right? It's not lowering it. It's just raising it. So money supply, yeah, it's another, as long as remove all that.
And personally, I'm more inclined to take the money supply number with a smaller grain of salt than I would the CPI numbers because those are a lot more subjective. those are more of a function of the times at the moment. The methodology always changes with the CPI number, whereas the M2
Yes.
money supply is just it's just an objective view
Yeah.
of how much money is sloshing around.
Unless they change the definition of it. But
Yeah, that's
look,
true.
I'm not too worried about that because if it's breaking out, no matter what the definition is,
Mhm.
the market is pricing in gold going faster than whatever the definition is of the money supply. And look at that, man. It's been a while. I haven't looked at it. We have a confirmed breakout last
Yeah,
month. It just happened.
nice.
It just
Breaking
happened.
news
Yeah, breaking
on the
news. Yeah.
monthly candlesticks too. That's a big deal.
Yeah. And probably let me go on the quarterly because it was also quarterly close.
Boom, confirmation.
Yeah, yeah. So
There you
we
go.
have a brand new fresh probably maybe the quarter before. We have a fresh new uptrend here. It's just happening. Look, higher highs, higher lows, and because we broke above a horizontal plane. Oh yeah, here the horizontal plane breakout was last quarter. So as soon as you're above a horizontal line, guys, by default, it guarantees that you have a higher high because because that line is defined by a reaction, a high.
Mm-hmm.
And I don't know if people see our cameras, my hand gestures when this is
Yeah, they can
published.
see them.
Okay, because I do a lot of so this is an uptrend. It's a higher lows and higher highs. So until this rising trend line here is support line is broken, where it's a new bull run for gold versus money supply. So that's more compounding evidence, versus inflation you're breaking out. And I'll show you something why this is important. Let's put the miners. Let's put the miners here. Put the
Mm.
Look at that. The miners track gold's performance versus other type of assets. Or in the look here, gold's performance versus money supply. Look in the 70s, how well it tracked.
Yep.
Here, they're bottoming together. They had a bull run together. They peaked practically together. So again, this is very good omen for the miners that this solidified uptrend here is happening for gold versus M2. That means capital flows are going more into the gold sector. That's just like crazy, like nice stuff. Like how many commodities charts look like that there? I'm pretty sure like there's a whole bunch of stuff there that looks like that chart of gold adjusted for money supply.
And it looks
Or
like the miners actually lead gold versus money supply. Like you see the troughs and the swings up
there, yes,
slightly a little
yes.
before, yeah, gold versus money supply takes off.
Yes, the true, but the like the paradigm shift type of breakouts because it went down so much. You think the breakout's on
Mhm.
here. So on the smaller time frames, there was a move up here off the bottom, but the true breakout is probably somewhere up here, and that probably matches close to where when gold broke out. Right, we're right around here. There. So this is the true breakout for the miners. It's like we're getting close to it there on the quarterly chart. It's yeah. So there's I don't like using the word catch up because nothing. It's kind of a fallacy when I hear people that, oh, Cameco went up all the way to its measure move target. The other miners have to catch up. No, they don't. If Cameco is a leader and it reaches bull run target, and that's the end of the bull run, the other ones that didn't do what they had to do, they'll just stay where they are and they'll die. It's like it just happens that if the bull run decides to continue and Cameco, let's say, decides to continue its breakout, then that means there's capital flows going to the sector, and those laggards have a chance to keep going up. But it's a dangerous game saying I'm going to buy something that's super cheap because it has to catch up. No, if it's super cheap, it's because it got destroyed because the market participants didn't like that thing. And it doesn't mean it has to catch up, right? They're leaders for a reason. The capital flows are going to that and they keep leading, right? They keep going up. So yeah, I know like people love off the bottoms, it went up 10,000%. But guys, the bottoms, you only know them in hindsight. If somebody tells you otherwise, how could you know it's a bottom without having a higher low? It's look at that. Like this thing, I'll show you an example. Like, a lot of people could have said, well, I'm going to remove the as a chart. I'll put the replay here. Oh, I'm not allowed to put it. Okay, but let's say we don't know that this exists here.
Mhm.
Let's say here I have a breakdown. We don't know that this was the low, right? That could have just been a downtrend below this line here. And the people say, oh, I cut but that could have just went like that, right? How do you know? How do you know that this was the low? at that moment, right? The evidence you have at that moment, you just don't know that was the low back here. You only know it's the low because it recaptured some bearish technicals, so it became bullish more, and then it got a new high. Then once you're here, that's why breakout's important, guys, because it's telling you the probabilities that the low is behind you, they drastically increase. So anybody trying to catch it here, it's nonsense, because somebody could have said here, oh, look, that's the low here, that's super low, but then it kept going down here, like, kept going down and down every time somebody's trying to catch the low. And sometimes you think you do catch the low, but then it goes sideways. That's not bad. That's not good either. Oh, let's say somebody did went in here, but then after that, it went back up. It didn't quite have a horizontal breakout line. The momentum still needed, that downwards move still had to be digested. Then you lost years going sideways, years. So the best chance, the lowest risk, highest reward opportunity is never trying to catch a low, guys. It's once you have confirmed breakouts above horizontal breakout lines, once the price has moved 50, 100% off bottoms, right? Like, I'm happy to see the price be 100% above the bottom when I get in. I love it, because that's telling me capital flows are going in and I'm in a new uptrend. It's like, sometimes it does happen. Like I catch the top or the bottom. I couldn't mention it, but it wasn't the design, Danny. It just happened like that, It just happened because that was the bottom, but you should never be proud of catching. Or did you ever do that? Are you guilty of doing that?
At times.
Yeah, but
it's not.
you have to admit that.
Yeah, I think what you're trying to say is that it's not a repeatable procedure.
No,
So you might
it's
get
not
lucky, but
yes.
it's not anything you can reliably repeat over time.
No, it's not. Because if people are honest together, really tally every single time you thought it was a bottom there, and market objectively, like a bottom in price, market on the calendar or wherever, and wait a lot of time. I'm guaranteeing you that you're more often wrong than right. Even on breakouts, I'm more often wrong than right. So try to catch bottoms. It's great for bragging rights, but over long periods of time, it's a losing proposition there. I'm
Here's
sorry.
something.
Maybe somebody could
Yeah, go ahead.
prove me wrong there, but like in a downtrend, every single one of these red candles, somebody could have thought it was the end, right? Right? Like every one of these red candles, oh, that's the low. That's the low. Like, how do you know that's the low? Well, you need some type of bullish evidence. You need it's crazy. I just don't get the logic of it. It's it's just crazy there.
Yeah. So I mean, the way I like to approach it is, if something is cheap, then I just don't like wasting the opportunity of not buying it. I just ask myself the question: is it cheap? And
How do you define that? By price? How do you define if it's cheap?
you look at a various number of indicators. Like you look at your PE ratio, you look at the price action as well, where it is versus its highs, and you try to get a best gauge in terms of how long you're going to have to hold on to this thing, whether it be a year, 5 years, 10 years.
So time frame comes into it. But I'll tell you something. I've seen in bull markets, PE expansion goes way beyond what you ever think. In the stocks I bought, like let's say whatever CNQ or something, there are stocks that we got in there. If I would have looked at the PE, I would have never bought CNQ at the price we bought it, because it's crazy. It's like, but the price earnings keeps going up. It's like people, and expands to crazy. Well, you would look the tech's the best example, right? Like any fundamental guy, his brain must be exploding by the crazy P to E's, right? And years ago, people calling tops in the market because the price to E expansion or average was so high, the Warren Buffett thing, or I don't know. But if they'd be basing it just on that, they would have missed out on all the whole bull run. And it's on the way down, the same thing also. When you think the price to earnings cannot get lower, it could get lower and stay lower for longer periods of time. Like we've seen that nonstop. It's just the market doesn't care. Price to earning 5-1, I don't care. You could stay there. I'm punishing that stock. You could stay there 10 years. There's no capital flows. You want to see price to earning expansion start moving up and breaking out and going higher. That's a bull run. You need the crazy P to E's, right? Like moving upwards. You don't want to, like, we just don't know where the P to E's are going to stop. Like, it's like But that's my take on it. That's why I don't look at company fundamentals, because I've often seen, and I've done that exercise. I've overlaid price to earnings on stock price, and it just doesn't make it just it don't make
No, no,
sense.
I understand perfectly. I mean, you're coming at it from a scientific standpoint where you're trying to find predictability in your methods, right? You want to repeat these methods over and over again. What I'm saying is that if like PE ratio isn't the only thing. I mean, there's price to book ratio. There's just fundamental, just knowing the fundamentals of a particular sector, like uranium, for example. When you're hearing about uranium back in 2021, all of this bullish news, you hear things like, the total market cap of the sector at the time was like 20 billion. At the height of 2007, it was at 150 billion. It's kind of like when you see stuff like that, I kind of like to nibble on some of that,
Mm.
nibble some on some of those sectors, so to speak. So that's the way I kind of approach it. But I mean, there's no objective best way to skin a cat. This is, the way I do it, it's more of an art form. It's more of a reflection of your personality.
Yes, and that's important. And that's the number one thing. No matter what you do, I'm not like judging. People they have to understand what's their personality. If I'm more analytical, I'm going to be, I love the chart trading because I have my sell stops, my position, my risk. I know exactly how much I'm going to lose. I know like if the price goes against me, I'm out no matter. But some people, they love the story. They like whatever attracts you, because that's going to make you sleep at night good, right? If you go in a trade and you can't sleep at night, it's like, goodness, don't do that to your health. Your health is number one. If you lose your health, your mental capacity, your trade is going to go, you're going to throw it out. So number one is just have a framework that fits your personality, your time frame. If you don't get the results you're looking for, then or you're stressed out, no matter just that means you're probably too leveraged, right? You just have too much. Let's say I want to dabble in fundamentals analysis. Let's say I wake up, look, Danny's convinced me, Patrick, stop it with the breakouts. You're buying too high. Let's try a little contrarian stuff. Try to buy it off the lows. Well, if I do that, I'm gonna not use a big position size. So even if I don't believe in the system or I'm not comfortable with it, okay, I lost a fraction of I'm gonna bet 0.001% of my NAV on that, and that'll be it, So there's that, right? There's the amount of money you put on a trade amplifies like your comfort. And that's probably another, I don't want to say that's a trick, but imagine you'd put your entire assets on one trade and you're not comfortable with it. That should tell you a lot about your thought process about getting in that trade, right? But goodness, I don't know if sometimes ignorance is bliss, and people, not ignorance is bliss, not in trading, but sometimes somebody thinks his framework's the best. He's got it nailed. Somebody sold him on the crypto idea. Or, it can only go up. There's limited amount of Bitcoins. And then he bets everything. He's comfortable with it. But then the objective chart-defined evidence is telling you that thing's starting to break down, but he refuses to pull the trigger because he believes in the thesis. Yeah, that's probably where I have my biggest issue with anything that's not chart-defined, Danny. It's just,
Yeah.
I've seen so many people get trapped on the thesis, and the thesis goes wrong. And then it's like suicide time. It's sad. The health deteriorates. It's like, what's happening? I believed in the thesis, and the price is not confirming the thesis. How do you handle that? I don't it's tough for me I don't know how people do it.
Yeah, I mean, that's why I always advocate, have some sort of disciplined portfolio allocation strategy. Don't go over a certain amount, whether it be 5% or 4% or what have you. That's kind of based on your risk profile. I kind of look at this stuff with the way I approach it is I don't like to touch my portfolio too much.
Mm.
And I based this off the Fidelity study and so forth, because even if I have to wait 5 to 10 years just to get like a 5x or a 10x, that's fine with me, because we can see these drop offs and these local bottoms, let's say, and I won't necessarily be buying at tops or sorry, selling at the tops, but I will, if I see a good enough opportunity on the way to the end of a certain run, I will buy more. So because I don't want to create taxable events as well. And that's
Yeah.
that's another thing I take into consideration with me. But that's just my personality. That's just my style. I don't like to get too involved in day to day, week to week, month to month. Kind of like to look at things from a yearly, if not more, time horizon, and kind of see like, is there an overarching theme? Much like the commodity market, there's an overarching theme behind the commodities market being that it's going to get a lot harder to get these commodities off the ground, and it's you're going to see capital start to flow into this sector in a way that hasn't occurred in decades.
Goodness. But let's say the price doesn't confirm that. Let's say it's going to be harder to get those minerals out of the ground, but let's say there's less people that want those minerals. So that's a net nothing.
Yeah.
And let's say they started
if there's
printing
significantly less people to utilize those minerals, and you've got other problems. You got bigger problems to deal with.
Yes, exactly. But your investment
than your
will probably
portfolio.
will probably go nowhere. It's there's so many moving parts, right? There's like, there's that moving part, like, it's harder to get those minerals out. But then there's a moving part that they could be printing less money. Then there's another moving part
Yep.
that capital flows will be going somewhere else. It's just like the beauty of the chart is like you everything's aggregated into that. So it's kind of good for you. Like, let's say you have or anybody who has like a non-chart defined thesis on why they went on something, but then they see me confirm their bias with that breakout of gold versus M2, it's like I hope it should help you. It should help whoever has a thesis, hope
Just,
that,
I mean, I'm more of a hybrid. I mean, I do look at the charts.
yeah.
We do look at the charts here on the channel, but I also try to pick out some qualitative signal. Let's say I'm kind of more of a hybrid.
Let's say I would show you the chart. Let's say your thesis is still good, but I show you the chart and I tell you, Danny, it's broken down on the quarterly chart. It's like it's broken down, Danny. What are you gonna do? You're gonna dump everything? Even if, let's say you started the trade and you don't like trading often, but it's breaking down the price. I'm telling you, it's breaking down. It's either going to consolidate for 2-3 years, or it could go down 30%. It could go down it could be a 10-year bear market. I don't know yet. Because I'll tell you one thing, every single time a consolidation starts or correction starts, that could be the top. People have to think about it this way. Every time you're in an uptrend, you're above the 12-month moving average, a beautiful rising trend line, that's great. As soon as that first breakdown, that the first trend line breaks down on the daily chart, my tingling says, okay, I'm not going to worry too much. I'm going to worry as defined by that daily chart. But now I'm going to start looking in the weekly chart, because if it starts correcting too long on the daily chart, it could cascade. I could have a breakdown of momentum on the weekly chart, and then that's how my time frame kicks in. That's how my like alert, like, goodness, if I wait too long, then I'll be selling in too much weakness. So there's like a sweet spot. You don't want to sell as soon as the daily fails, because now you're selling. You could be selling too preemptively, but if you wait too long, there's like a trade-off. Either you sell in ultimate strength and you try, or you sell in more weakness. But that first correction that happened on the smallest time frame could be the top, because tops always start with a correction on the smallest of time frames. People have to be wary of that, and you got to be. That's why the chart's going to tell you when that starts overflowing. Because by the time people, I'll wait, then there's so much damage done that then you've lost a monthly defined rising trend line, and then you could be in the 5, 6, 8, 10-year bear markets. I'm serious. Like, I think it goes back to what you say. I understand your time frame, but sometimes I feel people they get in as a shorter term trader, and then they get trapped because they weren't looking at the charts, and the thesis, the headline news did not confirm that it was time to sell, and often the headline news will never confirm it's time to sell. And then they get trapped, and then they become long-term investors. People have to be honest. A lot of people, that's what happens. They didn't think about staying that long, and then they just get trapped, and then they're long-term investors buying the dip, DC dollar cost averaging, losing their emotional capital, explaining to their wife why, like the family portfolio is down. It's, oh man, it's tough there. I think the toughest part is like just being honest with oneself. It's so weird in the trading world, where it's so easy to not be honest with oneself. And it's hard to see that you're not honest with yourself, because we don't want to accept that something's wrong. It's like we just, okay, the price is down. It's going to fix itself. I read this article about this guy that told me that the price will go up. It's like, I've done it in my beginning days. I went no charts, nothing. And then penny stock land, I bought some Donald Trump vodka and some crazy stuff, man. But I look at these charts today, 20 years later, they're either bankrupt or they're dot zero zero zero. Like they're just like they were scams. It's the charts will never lie to you. Like if you're an uptrend, if you're
No. I
it's
mean, I agree
objective.
with you. I agree with you. I look at the charts to make my decisions. I mean, I look at ratio. We look at things like ratios. We look at things like daily, monthly, weekly candlesticks, etc. But all I'm saying is that I don't if I see something that's has a certain asymmetry to it, then I just don't try to get too cute in timing it. If a better opportunity presents itself further down the line, i.e., another sell off, then I'm not all in to begin with.
Yes,
So,
yes,
like, my stop loss is kind of my position size. That's
yes.
how I kind of frame things, and I feel that's how it's kind of worked best with me. I'm more of a patient investor, I could say, but by that same token, I'm probably going to miss out on a lot of the money from the top and the bottom because I never perfectly get the bottom. I never perfectly sell at the top, but you just have to come to terms with that. And
Ah, goodness. Yeah.
yeah, so
I never get the top and never get
yeah,
the bottom.
no,
Or
yeah,
if I do, it's not the design, it's not the design of it to catch there are techniques, to try to,
yeah.
but
But the average person listening to the show isn't going to hit the tops or the bottoms, and they just have to come to terms with it, and you have to come to terms with the fact that they're going to leave money on the table, and that's fine.
they're not, that's okay. This is the word. The leaving money on the table it's a ROMO or FOMO um, line people have to get out of their head because they're going to start. If the more you keep saying something, the more your brain neurons are going to imprint that, and
Yeah,
you're
that's
going
a
to
good
think
point. That's a good point.
there's no such thing as leaving money on the table. There's only thing, did you make money or lose money?
Yeah.
Because there's there's always going to be a lower point than your entry point. There's always going to be a higher point than your exit point. So people have to stop feeling guilty about that because they're just going to destroy their emotional capital and it's going to make them FOMO into the next trade. Oh, I can't miss out on that one. Or I got out, the price went up after I got out. I'm so stupid. No, don't do that, guys. Don't do that. Whatever happens after you exit the trade, who cares? Who cares what happens after you got exit the trade? If you got out and you respected your framework, let's say you get out because you think the thesis is winding down or your ratio charts, and let's say the price kept rocketing upwards and some blow off top for the next year, don't feel bad about it, guys. Like you have to take that. That's it's dangerous stuff to reinforce there. There's no such thing as trying to grab everything. You're trying to get in at the lowest risk possible place, have the less amount of time that it goes sideways because that's emotional draining. You want it to keep going up like a beautiful S&P stock from 2012 to 2000, whatever, 20, just day after day, 1%, 1%, sometimes down a quarter percent. You can sleep like a baby at night. Who cares about it going up 10% a day? Because every time I see a stock go up 10%, 15%, I'm afraid that could be it. Because that's the type of moves that there's either a big correction after that, consolidation, which could convert into the beginning of a bear run. It's like, I don't like that. I like low volatility, get in and just keep piling in the money, blah, blah, like let all that money come in. And yeah, the only thing I could say about exiting a trade, and let's say the price does goes up, and you have to also be honest, how many times did you exit a trade and the price did go down? And not be proud of either of the situations or feel sad about either of the situations, but just try maybe to make your framework better if you think you can make it better and maximize more of your gains. So let's say you say, I did get out a little early, but wait until you have a high sampling rate, not just one occurrence, right? Look, I'm not looking at this the proper way. Next time I do my trades, if I have this type of target in mind, then I'll be able to maximize a little bit more. That's fine. Like analyze the data in hindsight, but don't feel bad about taking that decision based on your framework, right? Like if you have a computer program is going to do what it's going to do, and you can't change it live, right? It's after the fact. Oh, there was a bug. You fix it, and then the next time you run the program, it's going to run its due course, and then you decide, right? It's like, don't feel bad, guys. Don't hurt yourselves because you think you left some money on the table. Like that's devastating there.
Yeah, I mean the thing that I tell people is that find a methodology that works with you and stick to it. Don't try to
Yes.
change game plans midway through or quarter of the way through. Find something that works for you and just stick to it. And there might come times when you lose money, but the idea is that the expected value behind what you're doing makes you more money after enough trials, if that makes any sense. So
Yes.
along the way, you're going to make more money than lose money. So it's kind of
Yes.
like you know, it's kind of like a gambling uh practice. Is you kind of have a distribution in mind, and then you just act on that distribution in a defined way.
Yeah. Well,
um
poker players, great
yeah,
example.
you're expected to
They
lose money. It's the same thing with
yeah.
the casino. The casino always wins
Yes.
in the end. They may lose 48% of the time, but they win 52% of the time because the odds are in their favor.
Yes.
Now,
Yes.
if we had defined probability distributions of these stocks, it'd be a lot easier to predict, like we do a casino. But there's a lot more nuance that comes with
Well,
these markets.
well,
So
that's why the charts they come for me that I get I get the closest I could to actually have, we actually use probabilities, like we know because based on the results, let's say I have a 5-star breakout, horizontal breakout line. I know the probabilities, of reaching maybe that measured move that I had in mind. I could also calculate my risk versus my reward, right? So let's say I enter $100, but then I have a sell stop at $90, but a profit limit at $120. I know that even if I'm wrong half of the time, like I don't reach my target for whatever reason, half of the time I'll lose $1, but every other time that I'm right, I'll win $3. So $3 minus $1, I net $2. I could even be wrong 66% of the time. Let's say I'm right only one time out of three. I lose $1 when I'm wrong, and the other two times I win. No, the opposite. I lose $1 twice, so that's $2, and I win the other time that I'm right. I win three. 3 minus 2, it's $1.
yeah,
So if I reproduce that
one
over
step
and
back,
over,
two steps forward.
yes, I could do that 1,000 times. After that, it becomes mechanical. I don't even have to get attached. As long as my risk reward, as long as I'm able to win 3 times as much that I lose on every single trade, even if I'm right one time out of 3, goodness, man, you could throw a dart at it. Like you could do better than that there. Anybody could do that there. But you have to control your risk, because if you don't control your risk, and let's say you lose more than one, right? You're looking to win 3 and lose 3 on your trades because your I don't know, your sell stops are too wide, and you're letting the losses just pile in too much. Then that doesn't work anymore, right? Because if you're right half of the time, you'll be kif kif. But if you're right only one time out of 3, then you're just digging yourself a hole, because one time out of 3 you win 3, but the other 2 times you're losing 3 twice, 6. So you're digging yourself a hole, right? It's all about odds. Poker players know this, pot odds, and how much money they have to put to get those pot odds, right? And that's what trading is at the end of the day. No matter what you think about it, unless you think you're very good and you have a 90% hit rate, like, and you're able to time it, but it doesn't work that way, right? It's like there's enough volatility in the markets to make practically any trade just like go bonkers if you wait a certain amount of time there. It's just or you just sabotage your own trade. That people don't talk about this enough, but often let's say you have a long-term view, Danny, but you keep looking at the price every single day. What do you think is going to happen? You're stepping in line mines of possibilities of you bailing out too early on the drawdown, and then it moves back up. How many times has that happened to a whole bunch of people? I'm sure like everybody could relate to that. They have a short-term time frame, but then after that they get trapped for the long term, like we mentioned, or it's the inverse, right? They have a long-term time frame, and then they're on Twitter and they get happy for every 5% day it goes up, but then it goes up down 8%, and then they end of the bull run, and then they bail. It's like, goodness, it's a constant battle for humans it's all these instincts we have to fight,
Yeah, I mean that's how you get an edge, though. If we didn't have these instincts, then the market would be rationally priced at all times instead of
Well,
big swings up and down.
yeah, yeah, but sometimes I wonder if it's like, also there's big money coming in from big funds, right? And they're not the retail investors. Sometimes I'm wondering how much is a retail investor like buying and selling like their position on a dime? Are they actually moving the markets? Because maybe on the small timeframes, but let's say you're a pension fund and you have billions to allocate. You're going to wait till the quarterly close of the release, and then you're going to start piling in. Like you're going to tell your traders, well, I can't move the price that much, right? We need to buy 10 billion of that. So you're going to buy 10 million a day for the next 30 days, right? That's capital flows like feeding. So I'm wondering, like they don't care about a 5% day or down, right? Like, or headline news. They already had their decision to go in to buy Tesla months ahead. It has to get approved by the board of committee of the pension fund, and then they've already had their order just to start, buying no matter what. Like I don't know. Maybe the traders are going to start getting fancy a little bit, but they're not going to get fancy because the price goes down. The guy still has to buy, you know, whatever he has to buy, because the shareholders or the pension fund holders, they're expecting that, those quantities to be bought. So I don't know if sometimes I'd love to have evidence on this, like, but I don't know if the retail we do much. We think we might move, like sell it, like, like, I don't know. If we add up all of us together, all us retail, like we're probably nothing compared to the passive ETF flows, right? From the pension funds or the mechanized buying and selling, right? That's why it's important, those bigger time frames. You can't fight that. If gold's breaking out versus M2, that's like institutional money, whatever you want to call it. That's what's driving up the price, right? Us, we're just victim to the volatility in that, right? Because there could be some pension fund that also has to sell, right? A certain amount. With the battle of all these pension funds or whatever institutional investors, if there's more of that big money than the other ones, when the other ones are selling, then the price could go down. But if overall, over long periods of time, that guy hasn't bought all his billions and the other guy, is going to sell, but just slightly less billions, then that's going to skew the price upwards, right? And as investors, that's where we get the edge. We get to ride these beautiful bull runs with little drawdowns.
Yeah, I'm trying to look for any charts that include institutional versus retail capital. That'd be
I'd
really
love to try
interesting.
that.
Yeah.
Yeah.
If you guys in the comment section, if you can find a
Yes.
chart like that, be sure to drop it down. I'm going to look for one as we talk. But while I do that, Patrick, let's go ahead and run through oil. Oil's been sitting at $86. It's been making a pretty interesting run so far. So what's your take on oil?
Well, I'll show you a cool chart for oil. And it's my partner, Kevin, there and friend there. He did that chart. It's called the USL chart. And essentially the USL chart it's a super cool way, guys, because everybody, Patrick, you did a chart on oil futures. Yeah, but there's a carry costs. You have to, if you have to rotate, it's like a lot of trades, right? Every month you have to trade, or you could get a futures looking contract where, sorry, you won't have to close, or like it expires. You don't want to hold the oil contract and have, I don't know how many barrels of oil like delivered to your house, right? So there's this USL one, which actually is a fund where they buy 12 months evenly split of futures contracts, and they keep doing it for you. So every new month, there's a new futures contract forward looking, they buy it, and the other one that expires, then they just, they sell it, and they do it for you. So the chart, it's a smoothed out version of the oil chart, much more smoothed out. It's you see the peak here is less high. And look, I'll just show you guys the oil chart. I'll just show you the crude futures. Look how I'll put log scale here to match it. It was more spiky. It's way more spiky when you just look at the oil price, right? Look at that spike was much higher. But if you smooth it out, then you get the USL chart. And that thing it looks like CNQ. CNQ is already ahead of the curve. A whole bunch of oil plays, guys. A whole bunch, XLE. Look at that thing. It's like, it's beautiful. It's beautiful, Danny. Here's the momentum. The distance from 3-year moving average is also, well, it woke up here. So that means that explosion in price, distance from moving average. That's what I call FOMO profit taking levels. When you're so stretched from the 3-year moving average, which is this red line here, you're so stretched, and that's where everybody thinks it goes to the moon. You could keep getting stretched more, but if you're stretched and the price starts wavering, like it starts closing below a rising trend line and a shorter term trend line, moving averages like the 12-month here, then you have to accept you're in a correction, consolidation, which is either price and or time. And remember, again, the start, as soon as you realize you're in a correction or consolidation, that could be the top. That could be the top for the next year, the 2 years, 10 years. You don't know. There's evidence that it's not going to be the top for 10 years because you're still above a long-term moving average. You're still above the Ichimoku cloud. There's a whole bunch of, the ratio charts, a whole bunch of evidence that tells you that is just a correction, but it could have been the top. So the idea is you step aside, you let the dust settle, you let the market reset. So let that 3-year moving average catch up, rinse out all the, all the FOMO guys, the crowd, like everybody thought oil was dead here. But then oil starts moving up versus the 3-year moving average. Oh, now everybody thinks that's the one, but often you need to start morphing some type of resistance line into existence. And didn't quite have 3 reactions here, probably on the weekly chart. Let me zoom in there. There's probably, yeah, it's probably clear that trend line here on the weekly chart. So you had 1, 2, 3 here, a little reaction to red line. Confirmed breakout on the weekly chart for US oil. Confirmed. And here, if it closes the month here, you probably also have a confirmed breakout, and here above also previous highs. Goodness gracious, man. Danny, this is a resumption. So this could be the yields chart, right? I could put TNX on that and all that stuff. And even like uranium tracks this, whatever, copper. It's like,
I think copper to gold as well, doesn't it?
Yes, it tracks. What is it? Copper to gold?
Yeah, the copper to gold ratio. I think if you interlay it, I think it should track it fairly closely.
Yes, I like it. I like it. And
yeah, a little bit. No, not really.
Oh, what it's telling you is, well, maybe a little bit. So it's telling you that that's breaking out. There's a chance that copper will eventually
break through to the upside.
Yes,
catch up to oil.
Well, yeah. Without using the word catch up, it will be in an uptrend on its own price chart. Here's just like the copper chart. No, what did I do here? Yeah, that's the copper chart. Remove. So copper is looking great. Also, it's starting to wake up. So it's not quite as bullish as that US oil chart, but if you're the evidence, because the oil chart is doing what it's doing, then this is giving you some leadway that this has a chance also, right? It's starting, there's like maybe next month it'll have a breakout here, even I think on the weekly copper has broken out. Let me go on the weekly. Yeah, it's broken out on the weekly. So it's halting right here because it's hitting that wall there, previous support, support, it breaks down, resistance. So it's halting there. So what you could expect is some type of a little pullback here. And then after that, the next breakout is going to be bonkers. I shouldn't talk like that because it encourages formal, right? I shouldn't do that. I see I'm human. I do this stuff. It's a constant battle, That's why when I put in a chart and I put annotated lines, like this is a wall, it helps keep my human nature in check, right? Let's say I would go at the poker table and I have, I'd be a robot and I have my set. I do this if he does that. I do this if he does that. It'd be easy, but because I don't have that, it's fun at the beginning of the night playing poker, and then if I go on tilt, it's game over,
I think ideally the best way to be a trader is not to be invested in anything and just look at these charts as dispassionately as possible.
Yes.
But I mean, if you know something, you're going to invest in it because you want to make money.
Look at that. Look at that. Beautiful bull run above the 12-month moving average, above a rising trend line. As soon as you break down, it could go up, it could go down, but you're in a sideways move. You should never be in a sideways move. You should never. It's like, let's say you're in a bad marriage, you're gonna why would you should take a break there? Why stick around? You have that luxury in trading. As soon as you realize the price is not trending nicely upwards, you have the opportunity, to get out. You could do it. You're allowed, guys. You're allowed to do it. I understand like tax stuff, but it's kind of a trap because you think you're saving on taxes, but the price could be going down so much that whatever. It's like the way they see it is if you pay taxes, you made money, right? So that's a good, right? They'll never take 100% of your gains. So you try to see tax as a cost of doing business, right? It's not a brick and mortar store where you have to pay employees and electricity and all that. It's a trade. And if you want a tax-free haven, then go, open an account or go live somewhere where you're not burdened with taxes. But sometimes people who didn't sell because of tax reasons, they started going in a huge downtrend. And what's better, having actual losses or then paying taxes on profit. But yeah,
Yeah,
for copper
and
right
then
now,
by that same token, you also have to you also have an opportunity cost to pay as well. Say,
yes,
I mean, I've been holding this stuff since 2020. These oil stocks and these copper stocks and these commodity stocks in general, and I saw pretty good returns from 2020 all the way up to 2022. But the last couple of years,
yeah,
we've just been doing a whole lot of nothing, if not going down a bit.
it
But I
hurts.
mean, that's just the price. I've just come to realize, like for me, I can I can stomach. I have this uncanny ability to stomach these downturns that many people may not be able to the point where I can just kind of hold through the turbulence to make it to the other side, if there is another side. But
Yes.
that's the gamble there. But I'm not 100% in anything. I try to have very measured position sizing when it comes to these various sectors, to where the point where if it goes to zero, I'll still be okay. It's not life shattering or anything of that nature.
And that's good. I think it's like always say, let's say it goes to zero. Is it life shattering? Or a lot of people that have the income that keeps going in. So it kind of dilutes. Like let's say that Danny in 2020 had X amount of money. He put it in that stock, but that X amount of money is like inflation, right? Your salary keeps going in. You have so much more. So even if you lost, let's say 20,000 on whatever, I'm just putting a random number there, 20%. But because of all that money that came in, that's like it's so much smaller, right? Global, like because your NAV grew, it kind of dilutes that pain that was higher back then. So people who have a lot of liquidity coming in are able to stomach more these losses through huge drawdowns because it's not their entire portfolio. Their entire portfolio has that portion that's down. It's only if you DCA, you're hurting yourself because now you're making sure that drawdown is increasing, right? Hoping that one day it will do a yo-yo effect and bounce out, and then you'll be but it's so tricky. I don't know. Sometimes people DCA, I try to look into it and it just didn't make sense. But because let's say I would pile in, so much emotional burden. And then let's say it does go up. I'm probably going to sell too early because I hurt so much. Even if I have so much more invested, as soon as it starts going up, I'm probably going to want to break even, right? So it's tough. A
Yeah.
drawdown of five, you
If it
won't
was
believe this is
easy,
the bull
if it
run.
was easy, we wouldn't be able to make money off of it.
Yes, it's very tough because nobody believes if you're like, silver's been like the running gag, right? Every time they try to break out, rug pull, and it just kept making lower highs, creating that beautiful breakout line. And when it breaks out, people are looking at charts, they don't believe it. They say, we're gonna get another rug pull, and then they sell when they're break even. It's when all these people sell, that's when the price rockets because they're the selling pressure, right? That's the beauty of the base. If the price ain't rocketing upwards, it's because the base isn't complete yet. It's just not, right? And it could take 5 years, 10 years, 20 years, depending on the bull run. It could have a huge base, right? If you have a 20-year bull run in US equities, then you might have 5 years, 10 years of going it sideways. So there's yeah, yeah. That's it's crazy, man. We covered so much stuff there. The
Yeah,
emotional side is unsung. The risk, all that calculation unsung. People they want to watch a video and they want to hear me say $10,000 gold, like $1,000 silver,
oh, that's
but
going to be on the thumbnail now. In
but
quotes, $10,000 gold, Patrick Kareem.
but in reality, that's not. It's clickbait. I used to do it. I try not to do it anymore. Look, objectively, they're correct. These numbers, right? There's measured move targets. It's fine. Somebody could say the previous bull run did a 8x. I'm expecting that. That's fine. But that's not a trading framework. That's not, right? That's not the way you assess probabilities. You need confirmed breakouts. Silver might be up already 50%. And like you said, you're going to exit in like not at the top. and you're not going to run those whole moves, right? So just somebody said they did 10x before. People, what they do, they hear a guru say that 10x, then they're in their head, well, I have 10K, 10x. Oh,
Be
and
100,000. Yeah,
yeah,
they juxtapose a previous event onto their current situation.
and they're assuming that they're gonna that's the bottom that they're buying, and they're assuming that they will in the future buy the top. But while there's so many elements that are going to come in, right? You might need money to buy it to build a deck in your house. You might have a drawdown, makes you panic. You do the rug pull, and the bull run just might not be that strong this time. Did you think about that? It's like it's not guaranteed. That was a one time in a 40-year, 50-year. We had two bull runs in silver in 40, 50 years. That's a sampling rate of 2 times. So to assume that this bull run, it's just a range of targets. Like you could say, okay, if we have a low probability 10-year bull run, that's my expected target. But then you have to see how many times that have shorter bull runs, like bear market rallies. And then those are other probabilities of targets, and they're probably less greedy, more reasonable. So people should have their expectations set on that. And Goodyear, it's like 10
that's why you
years.
look at ratios, right? Is you're
Yes,
not just looking at these things priced in dollars, which is always a moving target. You look at things compared to what? To other assets. So silver to gold, silver to oil, whatever. Silver to M2 money supply, silver to CPI. You've got to be able to look at a buffet of different ratios and then kind of tease out what the signal is from the noise.
Yes, I'll show you maybe this one there before forget. So this is gold divided by CPI. We'll come back to that chart. And that chart, guess what tracks it? Silver. Silver, that's probably the ratio chart that I found that tracks the most silver price over long, over long periods of time there.
That's
like,
wow, that's
like it's
strong.
tracked it practically. Yeah. So you have gold. So people saying, oh, how come silver's not doing a new high? Well, because gold price in inflation has not done, it's not in a crazy bull run. It's not up here, right? Because so silver tracks that pretty much. But look what happened. Gold broke out. Let me reset the chart here. Look what's happened. As gold's breaking out, look what silver's doing. It's tracking that.
Yep.
So that was very omen-like when gold broke out here versus inflation, and it did a beautiful back test and broke out. Finally, silver. I'm going to move that on the new pane below, and kill this.
Why do you think that's the case? Why do you think
that's when
silver tracks gold to CPI?
Yes.
No,
that's when silver did its move right there. So
no, but why do you think that's the case though?
Because I don't know. Silver is gold tracks the US dollar's performance versus inflation. So I think we've talked about this there. The gold's purchasing power is the US dollar strength versus the euro or basket of currencies adjusted for inflation. Gold tracks that. And silver is like a derivative of that. It's like a better play. It's playing on gold's capacity to outperform inflation. And there's a whole bunch of other things like that. Like the Russell is a inflation adjusted version of the Dow Jones. So, or SPX, the Russell, that's what it is. Tesla tracks the Russell. Bitcoin is an inflation adjusted version of the NASDAQ. If I do the NASDAQ adjusted for inflation and overlay Bitcoin, that's what you get. So all these plays, they're like the baseline commodity or the alpha instrument is there. And then after that, once that is able to outprice inflation, then it opens the gateways for all these things there. Maybe, I don't know, maybe the purchasing, the cost to mine that silver, the silver mine, like the miners, the miners also track gold versus inflation a lot, and they track gold versus SPX. So a lot of the narratives around that was that, well, the energy costs are going up, so the margins are smaller on these miners. It's going to cost them more money, even if the gold price is up. It's going to cost them more money to get those ounces out. So, and they're like lagging, right? They're like, you have to adjust the price of gold because it will never be the price of gold that these mining companies will make, right? It'll be always you have to remove operating costs, right? Because for that share structure to be priced properly. That's my simplistic way of narrating that.
My suspicion is I'll plot this out in a second, but my suspicion is that once CPI rises, that implies a higher gold to CPI price because, to your point, higher CPI kind of instigates more gold buying because of that fear of inflation, which then allows gold to outpace CPI. No?
Yes. Well, gold, the market participants will start buying gold before CPI breaks out
Yeah.
when it's bottoming, actually, because they're
Yeah.
sensing, they know what's up, right? They know that those CPI numbers are going to get up. It's like almost a self-fulfilling. If gold keeps going up, racing CPI on the ratio chart, then people, oh, these guys are buying gold. It's like something like they're printing money, whatever reason. They know they need to balance their balance sheets with gold holdings. I don't know. The whole chicken and egg mechanism,
Yeah.
just
It
like,
affects their behavior. Then they begin behaving in a way that steamrolls inflation.
yes,
It
yes,
gets it
it
going.
reinforces it
Yeah, reinforcing
until,
inflation.
yeah, until gold breaks down. And when gold breaks down, you got to be really careful. That means your purchasing power, it stopped depreciating. There's like gold sensing that either the US dollar is going to gain strength versus the euro and all the other currencies, and or inflation is going to get subdued. And that's the end of the cycle. So you want to see gold outperforming M2, gold outperforming CPI. That means it opens the gateways for everything else in the commodity complex, right? The
Yep.
only caveat is now we need to see a rollover in the US stocks. That's the final piece of the puzzle. In the full-fledged commodity bulls era, the SPX is not outperforming energy and all that stuff. It's just not, it just doesn't, right? So right now it's holding its ground versus gold, but the Dow, I think it started breaking down versus gold, could have a breakdown this month versus gold. So that's the start. That could be the start of the real capitulation, the real capital flows. Doesn't mean US equities go down forever, but they're gonna go sideways more than just keep going up nonstop there. And the SPX, you got to remember, it's 11 sectors. There's basic materials in there, natural resources, there's oil, there's a whole bunch of stuff. So even if tech goes down a little bit, or it goes down, goes sideways, man, they have the other sectors to keep it afloat, right? It's beautiful, the SPX, very powerful engine over long periods of time, because it has all the other sectors that could help it, keep that bottom line there a little higher up there.
100%. Well, hey, Patrick, I don't want to keep you for long. Thanks so much for the interview. Where can people find you?
They could find me on Bad Charts One on Twitter, guys. That's the free for all. And if you want all like the nuanced stuff and the paywall stuff there, it's at northstarbadcharts.com. We talk about this all the time. We have the learning center, track trades, and the whole thing, guys. But yeah, man, this was fun, Danny. Really
Yeah.
appreciate. I love catching up with you. I hope I wasn't too hard. I
No,
always like,
this is great. Leave me a comment down below, guys. What do you think of our various methodologies? Which one, what is your methodology first and foremost? Drop me a comment. Let me know what your methodology, what your strategy is. So, no, I think this is good. I think every investor needs to have this top of mind. Just figure out what their strategy is, what their strengths are, and just be able to execute on it consistently, not stray away, not change game plans midway through, but consistently. But hey, any closing thoughts before we wrap this up, Patrick?
no, that's it, man. Can't wait to see what's gonna happen there with silver price and gold price and all that stuff. But yeah, it's steady as she goes, guys. And remember, if everybody's talking about it, you might be close to some type of top.
I haven't heard anyone talk about gold outside of our
No,
little
not yet.
gold
No, not yet.
community. So
And
which is very interesting.
everything's defined by time frame, guys, right? You can have some type of top on the smaller time frames, and it's a reset. It's just bear in mind that once the higher time frames start rolling over, you better not fight that stuff.
Yeah. Well, hey, like the video, comment down below, subscribe to the channel if you haven't already, and I will see you in the next episode. Thanks, guys.